Hey guys, another exercise I wanted to walk through on its own rather than do it in class is BE6.13. The reason I like this one, and this is important, it's kind of a standard sales entry where you believe there's going to be returns. Okay, so lots of companies sell stuff and expect they will have returns, and if you expect returns, you have to account for those returns at the time of the sale. Again, it's matching, right? You don't want to record sales of 100 items if you only expect to actually sell 90 at the end of the day because you think 10 are coming back. Okay. So if you read the question, give it a pause. We see we've sold these things. Selling price 700, they cost us 560. So let's start with kind of the ones we know. I'm selling to customers. I'm going to create an account receivable for $700,000. And I'm going to take $560,000 worth of stuff out of my inventory. That's what I ship to my customers. Okay? They're going to allow them to return them in 3 months if they haven't sold them or if there's damage or whatever. Past experience indicates that the normal return rate is 15%. So at the time of the sale, you want to record your estimated returns. The account they use in the book is refund liability. Sometimes we'd see an allowance for sales, and this is going to be 15%. So 700,000 times 15% is 105,000 is what I expect to get back. So I'm only going to record sales revenue for 595, the net that I expect to receive. So I think that kind of makes sense for a sales standpoint. I ship 700,000. I only expect at the end of the day to sell 595. The other 105 I expect to get back. So I've got this liability that I owe to my customers. I took 560 out of inventory, but again, matching, I don't want to record all of that as expense and cost of goods sold because I expect to get 15% back. And when I get 15% back, I'm going to put it back into inventory. So again, they call this account estimated inventory returns. Okay. And what is it? Well, 15% I expect to get back. And the other 85% is my cost of goods sold. Okay, so this is my normal sales entry for when I believe I'm going to have returns, and I can estimate those returns. I'll only record sales of what I expect to sell, and I'll only record cost of goods sold for what I expect to sell. So far so good, hopefully. Sometimes instead of setting up a liability, we do an allowance for returns and actually have a reduction from sales on our income statement, but this is the way the textbook's done it here, and that's what we'll do. So now it's 3 months later, and they've returned some goods. Granted credits of $78,000. So in the textbook, they use accounts payable, so they're actually saying we owe our customers $78,000. More often than not, we're going to take that out of accounts receivable because the customers haven't paid us for these things that they've returned. What should my debit be here, if we think of it? Right? Customers returned the goods. Do I have a refund liability anymore? The answer is no, because they returned it. Okay? So again, matching, you'll see neither of these accounts are hitting my income statement because I estimated how much returns I was going to get at the time of sale and recorded it then. Same thing on my inventory. Sorry. now I've gotten my returns. If I do the math, this is 62,400. If you want to, right, I had 560,000 of inventory out of 700,000 in sales. Okay, so here I'm figuring out my margin, or how much I made, is the 560 divided by 700. And that's the proportion I use every time something gets returned. So I'm not explaining this very well. So that's what I want to take out of here. And that goes back into my inventory. Again, nothing has hit my income statement because I estimated the time of sale. And the question goes on further to say, what happens now that the 3 months are over and they have no more right of return? Right? They've returned everything they're going to return. Well, essentially what's happened is I estimated I had a liability of 105. I actually only got returns of 78. So I need to get rid of the rest of that refund liability. And this is normal accounting too, right? My estimate wasn't perfect. And as I figure out my estimates are wrong, I want to fix them when I get better information. So in this case, I've got 27,000 of refund liability that I'm not going to need, so I can get rid of it. What's my offset going to be to that? What's my credit here? What we're essentially doing is saying, I recorded this entry at the time of sale because it was the best estimate I had. So I only recorded sales revenue of 595 because I expected returns of 105. Now 3 months later, I've learned that the 105 was wrong. Well, if the 105 was wrong, the sales number was wrong as well. So I need to fix it. So this seems like really bad matching because I'm recording sales revenue 3 months after I recorded the sale. But that's normal. My estimate wasn't perfect. As soon as I know my estimate was wrong, I'm going to fix it. And then I'm going to do the same thing for my estimated inventory returns. Right, I expected to get 84,000 back. I only got 62.4 back. I'm never going to get the rest back, so I don't need that estimate, that liability sitting there. And again, I'm fixing the initial entry I did now that I have a better estimate, so my cost of goods sold is going to change. So there's a few things that I kind of like about this question. One, matching. Do your best estimate of the returns, both from a sales standpoint and a cost standpoint. And when you know your estimate's wrong, fix it. Thank you.